Hello, everyone, and welcome to another episode of Coffee with Carl. Today, I want to address something that gets brought up at many of our presentations, our three-day events that we hold all over the country. Just to quickly introduce myself, for those of you who may have just clicked on this video, my name is Carl Zoellner, and I'm one of the senior attorneys here with Anderson Business Advisors. Today, I want to address the issue of double taxation in a C corporation. Now, everybody runs around and likes to talk about the double taxation in a C corporation, but there are many ways to pull money out of a corporation. There are a bunch of businesses out there that have run as C corporations for many, many years without, number one, generating a profit, meaning a taxable profit, but have been generating income to the business. So when we talk about C corporations, or if you get suggested a C corporation, we really need to look at the levels of analysis when we're talking about what is double taxation, as well as sometimes does it make sense to run through the double taxation scenario as well. So I want to talk about what double taxation is on this video. And double taxation, when we talk about in reference to a C corporation, is that if your corporation is showing a taxable profit, the corporation will pay a flat tax of 21% on that profit. The second level of taxation that people are referring to is normally when somebody takes a salary out of that C corporation. It is then taxable to the individual at their tax rate plus self-employment tax, which is 15.3%. Or if you adjust it, it's 14.13%. But either way, that's what everybody's talking about when they say double taxation. Now, like I mentioned, there are lots of ways to get money out of your corporation. Most frequently, or most common, would be depending on how much you're using your corporation or what you're doing in your corporation, is a great way to pull money out is through reimbursements. Reimbursements are not taxable to you as an individual because it is reimbursing you for either spending money out of pocket for an expense that belongs to the corporation or use of, say, a personal item of yours. So specifically in that regard, I'm talking about, well, in 2020 now, talking about the 57.5 cents a mile you get reimbursed for the mileage of using a personal vehicle for business travel. So there's lots of ways to get money out of your corporation. Really, unless you are looking to be more lendable, most times you won't be paying yourself out of a corporation, but rather, by the way, I'll do another video on that as well, of why you'd want to pay yourself a salary out of a C corporation and pay the double tax. But in order to be able to pull money out, like I say, there's lots of different routes. Number two is, if I simply want to pull money out of my corporation, I can always pay myself a dividend as well, which would be paid at long-term capital gains rates. And that's just one of the many different ways to take him out. So when we talk about double taxation, we need to really understand that not every dollar or every reimbursement that's coming out of a corporation is going to be subject to double taxation. We can also look at, and there's another video on this as well, is using 280A if I need to just put some cash in my pocket. So there's a bunch of different ways, and many times it sort of gets thrown out there without any sort of explanation on what double taxation is, or potentially how to avoid it, and like I said, I'll do a video on when it makes sense to take a salary out of a corporation and subject yourself to a little bit of tax up front from a business planning perspective. So when we look at what entity here at Anderson Advisors, when we look at what entity is appropriate for you, we're looking at, number one, what type of business you're in. Number two is what will give you the most tax benefit out of your corporation. And number three is, what does it look like when you need to pull money out of that corporation? To me, the double taxation issue isn't really an issue at all. It really says, well, if you're not doing any planning, you're going to have trouble getting money out of your corporation. And number two is that if you're depending on the type of business you're running, or if you just started in that business, or if you're a high W-2 income earner, it may make sense to make money in that corporation, because unlike a flow-through entity like an S corporation or partnership, I can actually, with a C corporation, control the flow of that income versus having to have it flow through to me as an individual. So that's it for this topic today. Like I said, I will put out another video on when it may make sense to pay yourself a salary out of a corporation. Until next time, thank you for joining me with another episode of Coffee with Carl. And as always, please take advantage of our free content. If you're not a client already, please call in. We'll give you a free consultation. Happy to go through your business structure, or you can even join us in person at one of our events we hold all over the country, all throughout the year. So until next time, thank you very much, and we'll catch you on the next episode of Coffee with Carl.